Hey everybody, this is Adele Folks, your instructor for Accounting 1. And thanks for joining me. Let's see if we can make some sense out of these dollars here on this problem. What we're going to do is describe the effect of each transaction on our accounting equation. And what we know here is that our accounting equation is assets equals liabilities plus owner's equity. And so we're going to take each one of these transactions. You probably want to go ahead and either print off or have open the same problem. It's posted in the same folder as the video. So if you haven't done that, go ahead and pause your video and print that out or open it on your screen, because as I scroll down, we're going to lose some of the problem that you see up here on your screen. So go ahead and print that out before we get started. And so we have 9 transactions here. These are typical transactions. And what we're going to do is classify these transactions in terms of their effect on the accounting equation. And with this exercise in particular, we are going to talk about those effects in plain English. So we have to understand the effect on the accounting equation in English before we can translate it to the accounting language of debits and credits. Okay, so let's take a look at the problem. It says that Brady Company entered into these transactions during May 2022, its first month of operations. And so the first thing that happened here was number 1, that the stockholders, the owners, invested $40,000 in the business in exchange for common stock of the company. So each transaction is going to affect at least 2 items in the accounting equation. That's how we are going to keep it in balance, right? We can't just affect 1 item or we are going to be out of balance. We can affect more than 1, but as long as it's at least 2. So if the stockholders invested $40,000 in the cash in the company in exchange for common stock, that means that the company now has $40,000 in cash that it did not have before. Cash is an asset. So we're going to come over here to cash and show that cash went up by $40,000. Okay, let's just also take a moment to work with your accounting equation. So what you will see here on the asset side is that we have the assets that we are going to use for this problem: cash, accounts receivable, and equipment. Of course, this could be expanded. We could have supplies and prepaid expense and notes receivable and land. Any of the assets that we have learned about in this chapter and the chapter before. Okay, we know that assets are a resource or are resources that we own or control that have a future benefit. Now, we only have 1 liability here, accounts payable, but we could have other liabilities as well. And remember that in our stockholders' equity, we are going to have 4 different types of accounts. So we are going to have common stock. And when common stock goes up, we know that owner's equity goes up. We're going to have revenues. When revenues go up, owner's equity goes up. And expenses. When expenses go up, owner's equity goes down. So we have a minus sign here because expenses are going to make owner's equity go down. And then we have dividends, same thing. Dividends make owner's equity go down. When dividends go up, owner's equity goes down. So we have a minus sign there. Now I'm going to go ahead and erase this so I have this space. Okay. All right. So again, stockholders invested $40,000 of cash in the business in exchange for common stock. So our cash went up by $40,000 and our common stock also went up by $40,000. And so we are currently in balance. We have $40,000 on the left side of the equal sign, and we have $40,000 on the right side. Okay, so let's take our second transaction. Let's make that one in green. Our second transaction we purchased computers for the office for $30,000 from LAD, that's a company name, on account. Remember, whenever we see the words on account, that means that we did not pay for something. If we purchase something on account, that means that we got the goods or the services, but we didn't pay for them. So we owe them, and we call that liability accounts payable. Remember, we can also sell our goods or services on account. And if we do that, that means we've provided the goods or services. So we've earned the revenue, but we haven't gotten paid. We call that accounts receivable. That is an asset. What is its future benefit? We're going to receive cash in the future, 30 to 45 days in the future. Okay. So we purchased computers for our office use for $30,000 from LAD on account. Well, computers are our office equipment, and we now have office equipment that we didn't have before. So our equipment goes up by $30,000, and we didn't pay for it. We purchased it on account. So now we have a new liability that we didn't have before. That's accounts payable. So we're going to include that here, $30,000 in accounts payable. And as we can see, once again, our left and the right side of our equation balance. What I like to do along the way is calculate a balance on the accounts. So we have, and then I like to see if we're still in balance. So this was our first transaction here. And this was our second transaction. Okay, so I like to add up the accounts and make sure that I stay in balance. So after this transaction, my cash has a balance of $40,000. And I have no accounts receivable. I have $30,000 of equipment. And I have $30,000 of accounts payable, $40,000 of stock, 0 revenues, 0 expenses, 0 dividends. So let's take a look at our balances. On this side, we have $70,000. And on this side, we have $70,000 and we balance. So we're happy. Okay. All right. So let's go to our third transaction here. And here we've paid $4,000 cash for May rent on our storage space. So this is rent that we paid for the month of May, and we paid it during the month of May. So that is an expense of our business. And we used our cash. So we paid cash. So we used our cash. So we're going to show for transaction number 3 that we paid cash. So cash goes down $4,000. And we also have an expense of $4,000 for rent. And what we know is that when expenses go up, shareholders' equity goes down. So we're going to put this as a negative $4,000. And let's make a note over here that this is rent expense. Okay, so we could then subtotal again and make sure that we stay in balance. So I'm going to do that one more time. And then I'm going to stop just in the interest of time. But if I were you, I would continue to check your balances along the way. Okay, so our cash, we have 40,000 and we just used 4,000. So, whoops. So we have $36,000 in cash. We have no accounts receivable. We have 30,000 in equipment. We have 30,000 in accounts payable. We have 40,000 in common stock. We have no revenue. We have 4,000 in expenses. Again, we have the minus sign because it reduces stockholders' equity. We have 0 in dividends. So we add this side. We have 66,000 on the left, and let's take a look at the right. We have 30 plus 40, which is 70,000 minus 4 equals 66,000 here on the right, and 66,000 equals 66,000. So we are happy. Okay. So let's go to transaction number 4. I'm going to stop subtotaling along the way, and we're just going to total at the end and make sure that that we equal. Okay. So transaction number 4. We performed computer services worth 19,000 on account. So again, this was on account, which means that we did not get paid. We're going to get paid in the future. We called that accounts receivable. That's an asset. It has a future benefit. We're going to receive cash in the future. So we now have a new asset we didn't have before. Our customer owes us $19,000. So for number 4, our accounts receivable asset goes up by $19,000. And the reason that happened was because we performed services. And if we perform services, then we have revenue over here. And revenues, when they go up, they make stockholders' equity go up. So we're going to add 19,000 and we now balance. And it looks like I accidentally erased some of that. So let me go put it back. Okay. All right. So transaction number 5. Let's go back to our purple. Transaction number 5. We performed computer services for Wharton Construction Company for $5,000 in cash. So we performed services, so we have revenue again. So we're going to have $5,000 worth of revenue, and they paid us $5,000 in cash. So we don't have accounts receivable. We actually got paid at the time that we provided the service. So for number 5, we have $5,000 in cash that we did not have before we provided those services. And we also have additional revenue of $5,000. Okay. So let's go on to transaction number 6. We paid Western States Power Company $8,000 cash for the energy usage in May. So we used utilities, energy, electric, and so that is an expense in our business. It's something that we incur in order to generate revenue, so that is an expense. And so our expenses go up, and when that happens, we know that, hang on, let's move this up a little bit. When expenses go up, we know that owner's equity goes down. So that was $8,000, and this was utilities expense. We could also indicate what kind of revenue it was, service revenue and service revenue. Okay, so we have utilities expense, $8,000, and the question is, did we pay for it, or did we use it on account and we'll have to pay it next month? It tells us that we actually paid them in May. So we used our cash, so our cash is going to go down by $8,000. Okay, and transaction, oh, and do we balance? Yes, we have minus $8,000 on this side. We have minus $8,000 on that side. Okay, so let's take a look at number 7. So number 7 says we paid LAD for the computers purchased in number 2. So let's come all the way back up here to number 2. Here it is. And in number 2, we purchased computers on account. So we had computers, our computers went up here. And then we had a liability that went up here. But now we have actually paid that liability. So that liability is going to go away. When we pay it, we don't have that liability anymore. So let's make that liability go away. Oops. Let's change our color to our black pen. Okay, so for number 7, we paid that liability. So let's make that liability go down. And we used our cash in order to pay that liability. So our cash also goes down, $30,000. Okay, so that is transaction number 7. We balance. The left side of our equation goes down by 30,000. The right side of our equation went down by 30,000. Okay, so number 8, we incurred advertising expense for May of $1,300 on account. Remember what I said about it being on account. If it's on account, that means we didn't pay for it. So we incurred those expenses, right? So they're going to be an expense of the current period, but we didn't pay for it. So that means we're going to have a new liability. We are going to owe for it. So we call that liability accounts payable. Remember, most of our liabilities have the word payable in them. The only exception to that is unearned revenue. Hopefully you read about that in your book, or we talked about it in class if you're in a face-to-face class. Okay, so we incurred advertising expense of May, for the month of May of $1,300 on account. So we have a liability that increases by $1,300. We now owe money that we didn't owe before. And we also have advertising expense. And so advertising expense, when it goes up, it makes owner's equity go down. So this is our advertising expense. Now, this is important to note here because we're done with this transaction. And look, this was transaction number 8. Everything that we did was over here on the right side of the equation. We had plus 1,300 and minus 1,300. That equals 0. What did we do over here on the right side of the equation? 0. We didn't put anything there. So does 0 equal 0? It sure does, and we stay in balance. So that's an important lesson. You don't have to do something on the left side of the equation and the right side of the equation. Sometimes everything that you're working with is on one side and they may net to 0 and you don't do anything on the other side. That's totally fine. Okay. All right. So let's go to number 9, I think is our last transaction. So number 9, we received $12,000 cash from customers for contracts billed in number 4. So now let's take a look at number 4. So here's number 4. And in number 4, we provided services. So we had $19,000 worth of service revenue, but we didn't get paid when we provided the services. So we had a new asset, accounts receivable, that went up by $19,000. So we've received $12,000 from the customers that we provided the services to in number 4. So we have cash that we didn't have before because we collected that cash from our customers. So our cash goes up by $12,000. And our accounts receivable goes down by $12,000. Why? Because when our customers pay it to us, they don't owe it to us any longer. Whoops, hang on a minute. Let me have that on the wrong line. Okay, so this is actually number 9. Let's go back to purple. Sorry about that. So we received cash. So our cash went up by $12,000. And when our customers pay us, they don't owe us anymore. So our accounts receivable went down by $12,000. So once again, we're done with this transaction. And this time, take a look. We have a plus 12,000 and a minus 12,000. So our left side of the equation changed by 0. All we did was exchange one asset for another. How about the right side of the equation? We have nothing over here in purple, so we did nothing over there. And so that is also 0, and 0 equals 0, and we balance. So we're happy with that. Okay, so the last thing that we're going to do, we did not calculate our balances along the way. So we're going to calculate our ending balances now. I think the last time that we calculated an ending balance was up here. So we're going to start with our balances up here on this line. And we're going to total our cash, our accounts receivable, our equipment, our accounts payable, common stock, revenues, expenses, and dividends. And then we're going to check to make sure that we balance. Okay, so we had a balance here of 36,000 in cash, and we added 5,000, we subtracted 8,000, we subtracted 30,000, and we added 12,000. So that total should be 15,000. I have these totals. I just need to use my flashlight here. Make sure I can see it. Okay, 15,000 is the balance of our cash. So let's take a look at accounts receivable. We're starting up here with these balances. We had 0 because we had already subtotaled. We added 19,000. We subtracted 12. So now we have a balance here of $7,000. Our equipment, we started with 30,000. We didn't do anything to equipment. We didn't buy any more equipment or sell any. So we have $30,000 of equipment. And if we total the left side, they equal 52,000. That's 15,000 plus 7 plus 30. So that equals 52,000. So let's check and make sure that we equal 52,000 on the right. So let's take a look at our accounts payable. We have a balance of 30,000. We subtracted 30,000 and we added 1,300. And so we have a balance here of 1,300. I'm going to put dollar signs here because these are our totals. And our common stock, we had 40,000. That was our only transaction. So we have 40,000 in a common stock. Our revenues, we had 19,000 in revenues and 5,000 more. So we have 24,000 in our revenues. And revenues make stockholders' equity go up. So we add it. Our expenses, we had 4,000 and then we added 8,000 more in expenses and 1,300. And those equal 13,300. And we didn't pay any dividends, so that is 0. Actually, what I want to do is we want to subtract our expenses because they make owner's equity go down. And if we had any dividends, we would subtract those as well. So let's take a moment and add our amounts here. We have plus 1,300, plus 40,000, plus 24, minus 13,300, minus 0. So I'm going to take a moment just to calculate that. Okay, 1,300 plus 40,000 plus 24,000 minus 13,300 in expenses, and that equals 52,000. And our accounting equation is in balance. So we balance those equations or those entries, those effects all along the way. and then we double checked at the end and made sure that our balances at the end also calculated. So your takeaways, remember, it's totally fine when you're first learning this. What you're doing is talking about the effect in plain English, and talking about whether these assets go up or down. And the same thing with our liabilities and our stockholders' equity accounts. And remember, be very, very careful, because we want to pay attention to expenses and dividends. They are different. When they go up, they make owner's equity go down. So we want to pay attention to that. All right. And then at the end, not only should every transaction balance, but at the end, we calculate the ending balance of every single asset and every single liability and stockholders' equity account. And then we should still remain in balance at the end. So I hope that was helpful, and you have some exercises to do on your own. And thanks for watching. If you have any questions, let me know.